You've got $100,000. What now? ETFs? Index funds? Hope for 7% a year? Put it in the wrong place and you barely keep up with inflation. Put it in the right 3 REITs and you're looking at millions in passive income. In this video, I'll show you and John exactly how to build real wealth using just 3 REITs, a 3-pillar wealth strategy built on income, growth, and long-term stability. And in the end, I'll show you how 3 specific REITs can turn $100,000 into a $3 million portfolio that pays over $15,000 in monthly dividend income. That's about $190,000 in annual dividends. Let's get into it, but first, let's lay the groundwork because most people are trying way too hard to get rich. Most people think building wealth means earning more, saving harder, or chasing fast-moving stocks, but true wealth isn't built from hustle. It's built from systems. Systems that deliver income, grow consistently, and don't rely on market luck. Warren Buffett is a great example. He's not out there flipping stocks every day. He just owns the right stuff, the kind of assets that pay him consistently. Coca-Cola alone sends him over $776 million a year in dividends. That didn't happen because he made some genius trade, it happened because he held on for decades. Now here's the big question, why REITs? Why not stick with regular stocks or index funds? Because REITs, or real estate investment trusts, are built differently. They're designed to pay you. These are companies that own real-world income-generating properties like apartment buildings, shopping centers, self-storage units, and even casinos. Instead of buying a building yourself, you just buy shares in a REIT. And because REITs are legally required to return at least 90% of their taxable income to shareholders, you get a good cut of the profits. That's the key. It's income now, real cash paid out regularly, often quarterly or monthly. REITs trade like stocks, so you can buy or sell them anytime through a brokerage. But unlike most stocks, they're backed by physical assets and long-term lease contracts. That makes their income streams more predictable. Another advantage is diversification. One REIT might own hundreds of properties across multiple states or even countries. That spreads out the risk. If one tenant leaves, the impact is small. If one location underperforms, others carry the weight. So when you own a REIT, you're not just holding a share of a company, you're holding slices of real buildings, real leases, real income without doing all the work that a landlord does. It's real estate ownership simplified and scaled. And now that we've got the foundation down, let's talk about what really matters. How much is enough? And what that looks like in real life. Let's talk real numbers. Right now, the average salary in the US is about $66,000 a year. Most people try to do the responsible thing. They put money into a 401k, follow the usual financial advice, and cross their fingers. But when retirement hits, the truth is kind of brutal. The average monthly check from Social Security is just $2,000. That's $24,000 a year. After decades of working, that barely covers the basics. That's not freedom, that's scraping by. Rent, groceries, meds, sure, but forget travel, helping family, or handling surprise expenses. And it's not because people are careless, it's because the system was built to keep people stable, not wealthy. So for this video, the goal isn't just getting by. I'm aiming to build a multi-million-dollar retirement fund that pays between $10,000 and $15,000 a month in dividends. Now that we've talked about the why, let's get into the how to actually do it. This whole strategy is built around just 3 REITs. Sounds simple, and it is, but each one plays a different role, and together they create something powerful. Think of it like a 3-legged stool. One leg gives you income now, another grows your money for the future, and the third keeps everything stable. Take one away, and the balance falls apart. But when all 3 work together, you get a solid foundation that lasts for decades. And that brings us to the first pillar, income, with the REIT GLPI, Gaming and Leisure Properties. GLPI operates in a niche sector of real estate that's often overlooked, gaming. It specializes in acquiring, financing, and owning casino properties, and then leasing them out under long-term triple net agreements. That means the tenants cover all expenses, property taxes, insurance, maintenance, utilities, everything. The REIT's only job is to own the property and collect the rent. That setup creates a steady, hands-off stream of income. These aren't short-term leases either. They typically span 10 to 15 years and often include built-in rent escalators. The tenants? Established casino operators with strong cash flows of their own. When they sign, they're locked in, and they're responsible for keeping the property running. That means consistent rental income, minimal overhead, and a business model that holds up even when the markets get bumpy. In the past year, GLPI's share price went up 2.93%. Over 5 years, it's gained 16.34%. And across the last decade, it's up 25.33%. So yeah, it's not shooting to the moon, but it's not meant to. The chart is steady, not exciting, and that's the whole point. This REIT wasn't built for big price jumps, it was built to pay. It's designed for dividends. And here's where that really starts to make sense. GLPI currently offers a dividend yield of 6.74%. That's solid cash flow right out of the gate, but it doesn't stop there. The dividend itself has been growing with a 10-year compound annual growth rate of 3.87%. This is exactly why GLPI holds down the income pillar. It gives you money now and keeps increasing those payouts over time. You're not betting on a price explosion, you're stacking consistent, growing income that shows up month after month backed by real rent from real properties. Now, in the end, I'll show you this REIT combined with two other pillars that can turn $100,000 into a $3 million portfolio that pays over $15,000 in monthly dividend income. That's about $190,000 in annual dividends. GLPI is also trusted by the biggest players. Institutions hold 95.67% of the outstanding shares. That's not by accident. Professional investors love this REIT for the same reasons we do. It's stable, it pays reliably, and it doesn't overextend. Analysts agree. With 15 buy ratings out of 24, the REIT holds a buy consensus. The average 12-month price target suggests a 19.24% potential upside from current levels. That shows confidence, not just in its income, but in the total return story. Now, we move on to the second pillar, growth. If income keeps your portfolio running today, growth is what pushes it forward tomorrow. And that's exactly what Extra Space Storage, or EXR, is built to do. It compounds relentlessly. This REIT is the biggest name in self-storage across the United States, and for good reason. With over 4,000 facilities in 43 states and more than 2.8 million storage units under its belt, it's everywhere. Boats, RVs, business inventory, college kids stuff, you name it, someone's paying EXR to store it. And because it's so big, it runs more efficiently than anyone else in the game. This REIT doesn't just own space, it maximizes it. It runs one of the most efficient platforms in the sector using advanced pricing algorithms, streamlined operations, and a strong national brand to drive profitability. Every time it acquires a property, it finds ways to extract more value. Financially, this REIT is as sharp as its brand. It maintains a strong payout ratio and doesn't overextend. It focuses on strategic growth, buying the right properties in the right markets and integrating them with surgical precision. Institutional ownership is another confidence signal here. Over 98.78% of shares are held by professional asset managers, a powerful endorsement of its long-term value and resilience. They're in it for what this REIT consistently delivers: reliable, accelerating growth. So how's it been performing? Over the past year, EXR's share price rose about 1.5%. In 5 years, it's climbed over 48%. EXR is all about growth. Over the last 10 years, it's delivered a total return of 123%. That's not from speculation, it's from consistent performance and smart reinvestment. The stock itself grows at an average of 7.99% per year, and the dividend? Right now, EXR's dividend yield is 4.25%. Pretty strong. And this dividend is growing even faster, with a 13.17% compound annual growth rate over the last decade. So not only are you building equity, but your income from it keeps getting bigger every year. It's the mix, capital appreciation plus fast-rising dividends, that makes EXR the growth engine of the portfolio that we're building. Also, analysts remain confident, with 9 out of 20 rating it a buy and the rest holding. 0 have recommended selling. The average 12-month price target is $162.79, suggesting an 8.23% potential upside from current levels. That's why this REIT anchors the second pillar. It doesn't just give you growth, it builds momentum. It's what turns a slow, steady portfolio into one that starts compounding faster and faster year after year. Now on to the final piece of our wealth strategy, the third pillar, stability. Income gives you cash flow. Growth builds your wealth, but stability is what holds everything together, especially when the market gets messy. And that's exactly what Agree Realty Corporation, or ADC, is built for. Agree Realty Corporation is a publicly traded REIT that's taking a smarter approach to retail. Instead of chasing trends, it focuses on properties leased to big-name essential retailers, the kind of companies that do well both online and in-store. As of 2025, it owns over 2,400 properties across all 50 states, and with more than 50 million square feet of space. These aren't risky bets. They're high-traffic locations tied to businesses people rely on every day. It operates in one of the most conservative yet powerful spaces in commercial real estate, necessity-based retail. That means it owns freestanding properties leased to tenants like pharmacies, grocery stores, and dollar chains. These are not trendy startups or luxury brands, they're essential businesses with consistent foot traffic, even during economic downturns. The setup is simple: long-term net leases, usually with top-tier investment-grade tenants. That means rent is steady and predictable. And the occupancy rate? It consistently hovers near 100%. Tenants rarely leave because the locations are chosen with precision and backed by necessity-driven demand. Institutional ownership tells the same story and then some. Over 98.36% of the REIT's shares are held by some of the largest and most risk-averse investors in the world. We're talking about pensions, university endowments, and insurance funds, the kind of players who can't afford to gamble. Their mandate is always long-term stability, low volatility, and dependable returns. When these types of institutions take such a dominant position, it's a vote of confidence. They've done the research, they've seen the balance sheets, and they're putting real money behind the belief that this REIT will continue to deliver decade after decade. And Agree Realty's performance over time tells a story of long-term strength. Over the past year, the stock climbed 22.28%, and across the last decade, it's delivered a total return of 150.77%. Additionally, its balance sheet is equally solid. A strong credit rating, conservative leverage, and disciplined capital deployment mean this REIT doesn't chase growth, it builds it, one carefully structured lease at a time. And that's why investors keep showing up, because it delivers quarter after quarter. Analysts like it too. Out of 21 ratings, 15 say it's a buy, and the rest say hold. None are calling for a sell. The current price target suggests 9.39% upside from here. And then there's the dividend. ADC's yield right now is 4.06%, not the highest, but it's steady. More importantly, the dividend has been growing at an average of 5.56% per year for the last decade. And with share price appreciation of 9.46% annually, you've got one of the most well-rounded performers in the REIT space. This is why ADC holds down the stability pillar. It's not about fast gains or high drama, it's about showing up, staying strong, and delivering through every market cycle. Alright, so we've covered each REIT on its own: GLPI for income, EXR for growth, and ADC for stability. Now let's zoom out and look at how they work together as a portfolio. Take a look at the table on the screen. This lays out the key investing metrics of all three REITs side by side, and more importantly, what they average out to when combined. The current dividend yield across the portfolio lands at 5.02%, which is strong, especially when you consider that it's coming from high-quality, low-maintenance real estate investments. So how did I get that percentage? Well, it's fairly simple. First, you take the dividend yields of each of the three REITs. GLPI is paying 6.74%, EXR is at 4.25%, and ADC comes in at 4.06%. Now, because we're building a balanced portfolio, we're assuming that you'll invest an equal amount in each one, 1/3 into each. So we take those three dividend yields and average them out. To do that, we simply add them together. 6.74 plus 4.25 plus 4.06 equals 15.05. Then we divide that total by 3, since there are three REITs. So 15.05 divided by 3, and that's it. Your average dividend yield across the entire portfolio is 5.02%. You can do the same for the dividend growth rate, which for this portfolio is 7.53%, and for the average share price appreciation, which comes out to 6.62%. When you put these three REITs together, you're not just diversifying, you're building something balanced and intentional. Each REIT fills a specific role, and the numbers in this table prove how well they complement each other. One pays, one grows, one protects. Now let's run the numbers and see what this portfolio could actually become over time. This is where the real potential shows up. Let's bring it all together. When you split $100,000 evenly across these three REITs, $33,333 each, here's what it would look like in the future. In the first year, your $100,000 would grow to $111,640. After 10 years, it more than triples to $306,462. Fast forward to year 20, and it'll be valued at $981,642. By year 30, you've built a portfolio that'll be worth $3,299,557 from a single one-time investment of $100,000. But it's not just the value that matters, it's what that value pays you. By year 30, this portfolio will be paying $190,247 a year, or roughly $15,854 per month in dividend income. The total value added to your portfolio will be $3.2 million, of which about $1.66 million comes from share price growth and $1.53 million from reinvested dividends. Don't have $100,000 to invest? Click the video on the screen to see how to turn a $10 daily investment into a $1 million portfolio.